Okay, so let us proceed with investment property, which is covered by IAS 40. In the Philippines, it is PAS 40 naman. So for our topics in this particular discussion, we will be having objectives and the scope. We have definitions. We have classification of property either as investment property or owner-occupied. Kasi yan yung general na or yung usual na naging issue. Investment property ba yung item or is it an owner-occupied property? Next is recognition criteria. We have measurement, initial and subsequent. We also have transfers and disposals. This is pertaining to items that are previously not included as investment property and then subsequently transferred to investment property, or the other way around. Previously investment property and then transferred to other classifications. And also we will discuss disposals of investment property. And finally, we have disclosures or the disclosure requirements. So let us begin with the objective and the scope of the standard, which is IS 40. So basically, from the title of the standard, which is investment property, the objective of the standard is to prescribe the accounting treatment for all investment property and related disclosure requirements. So later on in the definition, we will be discussing what are investment properties. With regards to the scope, the standard shall be applied in the recognition, measurement, and disclosure of all investment property, but it will not be applied or it is not applied to, first of all, biological assets because it is covered by IAS 41, and the property, plant, and equipment because it is covered by IAS 16. And also, it is not going to cover mineral rights and mineral reserves such as oil, natural gas, and other similar non-regenerative resources because this is covered by IFRS 6. So, those are the items. Because generally, although these items are considered as measured as at fair value, they are not treated as investment property because they are covered by a separate standard. So let us proceed with the definition. So the first item that we will define is carrying amount. So when you talk about carrying amount, it pertains to the amount at which an asset is recognized in the statement of financial position. The carrying amount may be based on the book value or the fair value because in this case, it depends on the accounting policy that is adopted by the company. So your carrying amount in the case of investment property may be based on either the fair value at the reporting date or the book value based on the use of the cost model. Next, let us discuss cost. Okay, so the reason why we are going to discuss cost is because under the cost model, of course, you need to recognize the investment property at cost. So cost is the amount of cash or cash equivalent paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction, or where applicable, the amount attributed to that asset when initially recognized in accordance with the specific requirements of the IFRS, example, IFRS 2, share-based payments, and other standards such as IFRS 16 in the case of leased assets. So, generally, the cost is pertaining to the initial amount that you surrendered or the amount that you have given up in exchange for the investment property. So, this is important, particularly because investment properties and property, plant, and equipment, which we will be discussing later on, are basically similar when it comes to the cost concepts or the initial cost of an item, whether that is through purchase, exchange, through government grants, or other situations. But basically, that is the component of your cost. We will discuss this in detail later on. Next is fair value. Again, similar to what I emphasized in our previous discussions, fair value is always referred as the definition provided in IFRS 13. So, similarly, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And again, under IFRS 13, there are basically three levels. The first level is the priority, which is the quoted price in an active market. Second is the observable data, and third is the unobservable data. So that is also the hierarchy by which we will apply fair value in the case of investment property. Next, we will discuss now investment property as defined. So investment property is property, land or building, or a part of a building, or both. Okay? So general, this will only talk about two types of assets, either land or a building, or it can also be a portion of land or building. Okay? Or it could be both also. Held by the owner or by the lessee as a right of use asset, because this is pertaining to IFRS 16 now, to earn rentals or for capital appreciation, or both, rather than for letter A, sale later on, use in the production or supply of goods or services, or for administrative purposes, or sale in the ordinary course of business. So basically, letter A is trying to define property, plant, and equipment, and letter B is trying to define your inventories. Okay? So generally, when you talk about investment property, we always we only focus on two types of assets, either land or a portion thereof, building or a portion also, or both. Okay? And they are not supposed to be used either as property, plant, and equipment or inventory. And later on, during transfers, the general transfers that we will be dealing with also is transfer from investment property to PPE or vice versa, as well as transfer from investment property going to inventory or vice versa. So those are the general transfers that we are going to account for later on. Okay? Next, what do we mean by owner-occupied property? Okay? So, owner-occupied property is property held by either the owner or the lessee under a lease transaction for use in the production or supply of goods or services, or for administrative purposes. So in other words, owner-occupied property is generally interchangeable with property, plant, and equipment in this case. Okay, so that we will not be confused. Okay, so because generally PPE are also properties that are are qualified in this particular definition. So that's basically what you need to remember or to consider when it comes to your owner-occupied property. Okay? So with that, let us now proceed with the classification of your property. Okay? Or classification of your investment property. Okay. So, first and foremost, we need always to remember that your investment property should either be land or building, or a portion thereof, or both. And the purpose why you are holding this particular assets is for rental purposes, to earn rentals, or for capital appreciation, or for both purposes. So when you talk about earning rentals, this is basically talking about your operating leases, or the simple leases that are wherein the lessees are only paying you rental, so you will have rental revenue, and the other party will have rent expense. Okay? And when you talk about capital appreciation, this pertains to the increase in the value of the property. Okay? So it's either one of the two or both. So that's basically the reason why you have an investment property. Okay, so if the reason why you are holding a property is other than for this particular items, then it will never be classified as investment property. So the standard provided us with specific examples of items of investment property. So first is land held for long-term capital appreciation. So meaning you are holding the land in order for the value of the land to increase, and eventually when the value increases, then you're going to sell it eventually. Okay, so capital appreciation or the increase in the value of your invested assets or the assets where you invested in. Next, land held for a currently undetermined future use. So you do not know or there is no specific plan as to why you purchased that. So generally, if that is the case, then that's by that's going to be classified as for capital appreciation also. That is because in this case, you are holding the land. You do not plan to build anything on it. You do not plan on doing anything to it or building a structure on it. So generally, it's going to be presumed that the reason why you're holding the land is because you wanted to basically get a return from its eventual sale later on, or basically because the value has already increased. So it is almost the same with letter A. But in this case, there is an undetermined future use. Okay? So that's basically for the second one. Next, uh, basically this is the justification there. The land is regarded as held for capital appreciation, similar to what I said a while ago. So even though there is no specific, okay, there is no specific provision that it is for capital appreciation, the mere fact that you are not doing anything to it is giving us a rebuttable presumption that you are holding it for capital appreciation. Next, a building owned by the entity or a right of use asset relating to a building held by the entity. So either the building is owned by the entity or leased by the entity in a finance lease transaction and leased out under one or more operating leases. So a while ago we were talking about for rental purposes as one of the reasons why you are holding investment property. When we talk about rental purposes, this is talking about your operating leases or leases wherein there is no significant transfer of ownership but simply a payment of rental. Okay? So that's also what is being talked about here in letter C. Letter D, a building that is vacant but is held to be leased out under one or more operating leases. So at this point, it is vacant, but the intention is for it to be leased out under operating leases. So still the same. It still satisfies the definition of an investment property. Letter E, property that is being constructed or developed for future use as investment property. So even though an item is still under construction, you can already classify it as investment property. Okay? So, in this case, since the property is not yet fully constructed, you are going to accumulate first the costs involved in the development and construction of the asset, and later on, you're going to remeasure it upon the completion depending on whether you are going to use fair value or cost model, which we will be discussing later on. Okay. So the following are examples of items that are not investment property. So the standard also provided us with some examples of items that are not considered as investment property. So first is property intended for sale in the ordinary course of business. So this is obvious because it is intended to be an inventory. Second, owner-occupied property, including property held for future use as owner-occupied property. So there is already an intention for it to be owner-occupied or for it to become a PPE later on. Property held for future development and subsequent use as owner-occupied property. So it is intended to be a future PPE, property occupied by employees, okay, whether or not the employees pay rent at market rates, and owner occupied property awaiting disposal. Okay, so let us dissect this second bullet point. Okay, so the first item, held for future use as owner occupied property, is treated as PPE. Then property held for future development and subsequent use as owner-occupied property is classified as PPE. Property occupied by employees is also PPE. Why? Because employees are considered to be related parties, regardless of whether the employees are paying rent or not. Because you might be saying, sir, in this case, the property is being rented out. So you are earning rent or rent income. So in that case, it satisfies the requirement of the item to become an investment property. Okay, the answer is no. And the reason is because employees are considered to be related parties. Okay? Or related parties to the business. Okay? So regardless whether the employees are paying rent or not, okay, the item is still considered as PPE. Okay? And finally, owner-occupied property awaiting disposal is now going to be considered as items under IFRS 5 or non-current asset held for sale. Okay, so those are the classifications in this case. Third bullet point, property that is leased to another entity under a finance lease. So, again, to reiterate, since it is already leased out to another entity under a finance lease, there is already a transfer of the substantial risk and rewards related to the asset, then there will be a derecognition on the part of the lessor, okay, which means that there is no more asset on our part. There is no more leased asset on our part. We only have the receivable relating to the finance lease. That's why there will be no asset to be classified as investment property in this case because the lease is already a finance lease. So in substance, the property now belongs to the lessee, okay, and the lessor will only receive future payments. So the leased asset will be transferred to the lessee in this case. Okay. By the way, this will be discussed in detail later on when we are already in leases or when we are going to discuss IFRS 16 already. Okay. So there are instances wherein some properties comprise a portion that is held to earn rentals or capital appreciation, and the other portion is held for as PPE, just to make it short. Okay? So there is a certain rule or guideline provided to us by the standard so that we will not be confused. Okay? So for the first bullet point, okay, if these portions could be sold separately or leased out separately under a finance lease, then the entity holding that asset accounts for those portions separately. Okay? So the first thing that you need to ask is, can you sell it separately or not? If you can sell it separately, then you account for the portion separately also. So in case of the land, if you can sell it separately or you can subdivide the land and eventually sell it later on separately, okay, then the one portion will be investment property, the other portion will be PPE. Okay, similar with the building. Okay, you basically you can do this by accounting for the floors, the number of floors in the building, or the square meters that is covered by the leased portion or the item that is considered as investment property and the portion that is considered as PPE. Okay? However, in the second bullet point, it says there, if the portions could not be sold separately, meaning it is not possible for us to sell the property on a piecemeal basis, okay? Or on a subdivided portion, okay? So if it could not be sold separately, the property is investment property only if an insignificant portion is held for use in the production or supply of goods or services or for administrative purposes. Okay? So, this is where judgment will come in. Okay? Because the property cannot be sold separately. Okay? Take note, an investment property is either held for rental or for capital appreciation, and eventually if that is for capital appreciation, you intend to sell it later on. But if the portion cannot be sold separately, okay, you cannot automatically say that this portion is investment property, the other portion is not. Because if you have an investment property, always remember the eventual intention of management there will be to gain from its capital appreciation, or basically to sell it later on. Okay? So, in that case, you cannot automatically recognize the portion as investment property and another portion as PPE. It says here, it will only be investment property if only an insignificant portion is held for use, or only an insignificant portion is only an insignificant portion is PPE. Okay? So what is our decision guide here? If the portions could not be sold separately, then it can only be investment property if the PPE portion is insignificant. If the PPE portion is significant, then the entire property will be classified as property, plant, and equipment. Okay? The reason behind is, since you cannot sell it separately, if you intend to sell it later on, it is going to be sold as PPE and not investment property. Okay? So that's basically how it works. So with that, let's proceed to the next portion. There. In some cases, again, an entity provides ancillary services. Okay? So when you talk about ancillary services, these are basically secondary or auxiliary or support services that we give to our occupants. Okay? So this is also one of the decision guide by which we will determine whether the property we are renting out should be classified as PPE or should be classified as investment property. Okay? So according to the standard, if the ancillary services are insignificant, okay, in relation to the arrangement as a whole, okay, or generally, you are going to compare the amount that you are charging to your clients, or the amount that the tenants are paying, as compared to the total amount of the ancillary services. And if the percentage is insignificant, then the property is investment property. Okay? So let's just provide an example. Example, if the tenant is paying 10,000 pesos and the amount of ancillary services is, let's say, only 500 pesos. So 500 divided by 10,000 is around 5%. Okay? So 5% ancillary service is considered to be insignificant, but of course, this is a matter of judgment. But as a general rule, this is already insignificant. Therefore, the ancillary services as compared to the arrangement as a whole is insignificant, and therefore the property being rented out is an investment property. Okay? So that's basically how it works. Similarly, the examples given by the standard will be security and maintenance services in office buildings. Okay? So that is considered to be insignificant. However, there will be situations wherein the services or the ancillary services are now significant. Again, how do we determine if that is significant? You get the amount that you are going to pay in relation to the ancillary services and divide it by the total amount that you're going to receive in relation to the rental that you're going to receive from the tenants. And in this case, if it is significant, okay, then it is now considered as property, plant, and equipment or owner-occupied property as compared to investment property. So the example given by the standard is in the case of hotels. So of course, hotels are generally accepting clients, okay, for the clients um, to avail of their accommodation services. So in this case, the amount that is being paid by the clients or the customers is going to be, or the amount of services that the clients will receive in relation to the amount that they are paying the hotel is automatically very significant. So therefore, in that case, the ancillary services are significant in relation to the arrangement as a whole, and therefore, the property being rented out is considered to be PPE instead of investment property. Okay? So, this is what I was talking about a while ago. The standard also provided that there are instances wherein it is difficult to determine whether the ancillary services are significant, okay, or not. Okay? So, in this case, the standard stated that it is possible or it is probable that there will be judgment needed. Okay, or judgment will be needed in determining this later on. And so what is required by the standard is for the entity to develop a criteria. Okay? So this is, since the standard is not rules-based, since the standard is principles-based, what the entity will do is to establish the criteria so that later on, if certain difficulties arise, the criteria will serve as the basis of whether the property will be classified as investment property or PPE later on. Okay? So it's up to the entity. But of course, the guideline should always follow the general provisions of the standard. So an example here could be to provide a certain threshold of the percentage of the ancillary services. So if, let's say, for example, the criteria developed by the entity is if the ancillary services does not exceed 30% of the um, total rental arrangement or total rental fees, then it is still insignificant. So that could be an example or that could be a policy. But of course, that is going to be case to case depending on the criteria developed by the entity. So it's up to you later on. The concept here is you simply need to have a criteria because that is the requirement provided by the standard. Okay. Also, in classifying your investment property, okay, judgment is also needed in the case of business combination because you need to determine whether the acquisition of investment property is the acquisition of an asset or a group of assets or a business combination within the scope of IFRS 3. Why? Because generally, if you try to go back to the concepts of business combination, there are two types of business combination. One is a business combination under acquisition of net assets, and number two is business combination under acquisition of uh, net assets in the form of shares, okay, or acquisition of stock. So in this case, this provision is talking about items that are, or items of investment property later on that could be considered as an individual asset or basically just a component of assets to be acquired, or is it considered as a group of asset, or is it basically the entity that is being purchased, okay, in the which is going to be part of the business combination. So later on, if because later on, if that's the case, it is possible that the acquisition of investment property class or qualifies as a business combination, and therefore it will affect your consolidated financial statements later on. That's why you need to check, okay? You need to check later on if the acquisition of the property is a simple acquisition of asset or maybe it is already an acquisition of net asset that is under IFRS 3. So that's basically what is trying to, or what this provision is trying to say. Okay? Next, the standard also states that in some cases, an entity owns property that is leased to or occupied by its parent or another subsidiary. So this is pertaining to related party transactions. Okay. So what does the standard say? When it comes to the consolidated financial statement, the property is not considered as investment property. Why? Because talking about related parties again, since the property is occupied by a related party, either a parent or another subsidiary, then in the consolidated FS, the property is PPE instead of investment property. However, in the individual FS of the entity, it can be an investment property. Because if we are talking about the separate FS, the entity who holds the investment property and either the parent or subsidiary are considered to be two separate legal entities. So in that case, it is treated as an investment property. But if we are talking already of the consolidated FS, the investment property will be classified or will be reclassified as from investment property going to PPE. Okay, so that's just the discussion there. So later on, if you're going to encounter such questions during the board examinations or your quizzes or whatever, that check whether it is talking about the consolidated FS or it is talking about the individual FS of the lessor. Okay. So with that, we now go to the recognition criteria. Okay? So the recognition criteria for investment property is basically very the common definition for the asset recognition found in our framework. And of course, prior to recognition, the investment property or the property should already satisfy the definition of investment property as found in the definition section of our standard. So once the item is already considered as investment property, what you need to do is to simply check whether it satisfies A or B. So first, it is probable that future economic benefits that are associated with the investment property will flow to the entity. So this is the probable inflow of economic benefits. And second is the cost of the investment property can be measured reliably. Okay? So that's very basic. So under the recognition, okay, an entity evaluates, okay, under this recognition principle, all its investment property costs at the time they are incurred. Okay? So because cost is very important, generally it is for initial recognition, the entity needs to make sure that all components of costs are included. So what are the components? First, costs incurred initially to acquire an investment property and costs incurred subsequently to add to, replace part of, or service a property. So this is pertaining to enhancements or improvements. Okay? So costs can be classified as initial cost or cost of enhancement or improvement. Okay? But we need to be careful because according to the provisions of the standard, the costs of day-to-day servicing, okay, should not be capitalized as part of cost but rather recognized in profit or loss as incurred. Because these items are considered as revenue expenditures or expenditures that are described as repairs and maintenance. So going back, if we talk about cost incurred to replace, improve, okay, or add or to service a particular property, it does not include day-to-day servicing. Okay? So if it is considered as repairs and maintenance, then it is not capitalizable as added cost, but rather it is expensed and charged to profit or loss. So going back, you need to assess again because the standard again did not provide us line items of those day-to-day services or those day-to-day servicing costs. So what you need to do is to make judgment again later on and determine whether these additional costs are going to enhance or improve the asset or it is just going to maintain the asset. Okay? And of course, we have a decision guide there in order for us to consider if the expenditure is subject to capitalization. We need to check whether the said expenditure will increase the life, will increase the productivity, or decrease the subsequent cost later on because it will make the property more efficient. Okay, so those are the three things that we usually check. If it is going to increase the useful life, if it is going to increase the productive capacity, or it is going to lessen the cost of maintaining it later on. Okay, so those are the three criteria to check or basically guidelines for us to check whether the subsequent cost can be capitalized or not. Okay. So again, okay, parts of investment properties may have been acquired through replacement. Okay. So in this case, if there are replacements, what are you going to do? Okay, the recognition principle, okay, or under the recognition principle, an entity recognizes in the carrying amount of an investment property the cost of replacing part of an existing investment property at the time the cost is incurred if the recognition criteria are met. So this is relating to the cost incurred subsequently. Okay? So it says here, generally you just like what I said a while ago, you simply need to check if the subsequent cost is going to qualify for recognition as an enhancement. Okay? Which is going to be based on whether it will increase the useful life, it will increase the productive capacity, or decrease the cost of maintenance later on, or cost of operating the asset. So if it qualifies as an enhancement, then it will be capitalized as additional cost. So that's as simple as it can be. Okay? So, however, again, this as provided by IFRS 16 in the case, okay, of assets held by a lessee as a right of use asset, which is the term used in IFRS 16 for leased asset, it will be recognized in accordance with IFRS 16. So when we go to IFRS 16 later on, that will be, or the capitalizable cost under IFRS 16 will be the capitalizable cost to be recognized, okay, under investment property if it qualifies. Okay?